I mean, last week we felt great, right? I mean, maybe the Fed will ease up a little bit. Stocks rallied, but let's not forget that some of the biggest runs occur in down markets. I think the 2001 downturn had something like 8 rallies of more than 20%, even while the market fell 75% over 2 years. What's your expectation going forward?
Yeah, I think that, as you mentioned, bear market rallies can be tremendous. We have turned neutral here. We came into the year underweight equities and underweight fixed income with a short duration bias. And we've closed out both of the underweights, actually, with financial conditions really easing up miraculously in a short span of time. So we think that we're more neutral on the equity side. On a broader dip, we would look to go overweight. And we've closed the underweight on the fixed income side, too. We're still a little short duration, but especially in the front end, we feel like the market's pretty fairly priced here. Fairly priced.
Anthony, listen, we had this. You're the interest rate guy. Last week was all about the Fed maybe easing off a little bit. Nope. Waller kind of punching the market in the gut yesterday over there in Germany, saying we're going to go 50 basis points, or suggesting that's what he would do, by the way. What's your take on how much changed, if any, in the last 24 hours?
We would say that not much has changed. And when I say not much has changed, I'm defining it from last week. What you saw was in the Fed minutes, investors started to get a little bit of euphoria. They were optimistic that we may see a Fed pause in September. We think that's premature. We think that the Fed goes 50 basis points in June. We think the Fed goes 50 basis points in July. And we think it's going to be imperative for the Fed to keep in tightening mode here, because when you look at inflation, we're still hovering near 4-decade highs. And then secondly, when you look at the decomposition of inflation, we see a particular big impact, negative impact to lower income and middle income households with food inflation, rent inflation, and gas prices so high. Yep. So we think that the Fed is going to have to continue to raise here.
Yeah, Anthony, I'll go back to you on that. And I think you're bringing up a really important point. I know we focus a lot on energy costs. In many ways, energy is the economy. I get it, gasoline. But the Federal Reserve is raising rates in a market where housing, whether you're buying or renting, is already out of reach for a lot of people. Credit card rates, revolving credit limits, they're going to go up as well. But many people would argue this is a supply-driven inflation crisis, sort of 2-year backup of supply chains. What can the Fed do about that?
Yeah, unfortunately, from a monetary policy perspective, the Fed, their policy typically counteracts demand. But this is the problem with the Fed being so complacent for so long. Unfortunately, they have to use this blunt tool to try to corral inflation. We do agree that there is some risk from the housing market. Affordability has worsened for sure, with mortgage rates above 5%. But at the same time, if you look at some other parts of the economy, particularly the labor market, right now you have 2 job vacancies for every unemployed person here. That's record levels. So The Fed has to do something to try to slow down the momentum in the economy and slow down the overheating.
Yeah, well, if the Fed could put in about 100 oil wells, that might help. Mimi, where's the best place to invest right now?
So we like baskets of diversified assets. And I agree with everything that Anthony has said. I don't think that the Fed's going to pause anytime soon. I think they really need to see a clear and convincing argument that inflation is slowing. So we like basket of assets. On the equity side, we like equities that can perform well in the energy transition, like UK, Norway, clean energy stocks. In fixed income, we really favor the front end, but we're seeing, we do think there's a lot more demand at these higher yields than we would have seen, say, at last summer's levels. So we like a basket of diversified assets, including real assets, importantly.